So in the next 3 minutes, I'm going to show you why a recession is coming. I had an overwhelming response about my last post about the recession that I said is a mega recession. It's coming in the next 12 to 36 months. And I'm going to tell you exactly why that's happening. Now, the economy is at the peak of a business cycle, and the economy right now is about to contract. And I want to explain to you visually what that means. So as we can see in this chart right here, this is business cycles over the last 100 years. We can see starting way back in 1930, we've had booms, busts, boom, bust, typically every 7 to 10 years. We can see the dot-com bubble here around 2001. We can see the housing crisis in 2007, 2008. And now we can see a huge run up in the market right now. We've actually pushed over the typical 10-year economic cycle, and that's where things start to get a little scary. So if you like what you're hearing so far, go ahead and hit subscribe. What we're looking at this part is the business cycle broken down in the phase. You can see everything in the long term moves up and to the right, just like we saw in the S&P 500. There's an expansion cycle like we're going through right now. But then over time, things contract. It's a natural expansion, contraction, expansion, and contraction. You may have heard me say this in a previous podcast, but our economy is like a pendulum. It just swings back and forth, back and forth. Bull market, bear market, bull market, bear market. And it does this over and over forever, and it consistently picks up and to the right. Now, the thing is, what we're seeing here over the last 10 years, using the S&P 500 as a proxy for the entire market, we can see that there has been an incredible rise in the prices across the entire market. Now, this is a huge red flag. This is telling us we need to pull our money out now. And you might say, hey, the economy is going well and it's going to keep going well. We've bucked the trend. I'm going to show you exactly why to pull your money out of the market right now. This is called the yield curve. And there's something called the yield curve inversion, which is essentially the harbinger of death for the economy. So I think that sounds really extreme, but what I want you to know is that this is real and this is happening. It's going to happen soon. So normally we have the blue line, which is the Treasury will pay roughly 1% for a 2-year bond and maybe like 5% for a 10-year bond. The Treasury is going to pay you more interest if you give them money for longer. However, as things flatten out or even possibly invert, the US Treasury will pay you more if you give them money for 2 years than 10 years. And that just means that people are betting that the future is going to be worse than today. And they would rather invest short term than long term. And that essentially goes against all investing wisdom. So where are we in this, cycle? We can see just a year ago, this blue line, that looks pretty familiar, that yield curve, just like this blue line, a nice up and to the right. Today, this black line, the yield curve is flattening out. That means we're getting closer to this inversion. We can see that the 10-year Treasury bond is today at 2.66%, whereas a year ago it was 2.8%. And you might say, what does that matter? What really matters is the comparison of the 2-year Treasury bond or the Treasury note. And you can see here that just a year ago in the black line, a year ago in the blue line, it was 2.1. It's already risen to 2.5, which means the yield curve is about to tip forward and pay more for a short-term investment, which is really bad. To really nail this home, I'm going to pound this into your heads. The US 10-year Treasury is taking a nosedive. Not only is the 5-year climbing, or the 2-year climbing, the 10-year note or the 10-year bond is dropping just drastically from 3.2 all the way down to 2.6. Taking this a step further, the spread between the 10 and the 2-year Treasury is just dropping and dropping and dropping and dropping. And as soon as this gets to zero, that's when we have a flat curve. And if it goes negative, that's an inverted curve. And we can see we are so close to that. So how does this all factor in to the economy and basically a depression or a recession or a contraction, whatever you want to call it? Well, take a look at this. Historically speaking, every time there's a major recession, it's predicated by a yield curve inversion. Ding, ding, ding. This is the key to everything right here. Right before we had a recession, yield curve inversion. Recession, yield curve inversion. Recession, yield curve inversion. You get the idea. And these oscillations, these swings, they're getting bigger and bigger. The dot-com bubble, the housing, and now this next issue might be the global economy, debt crisis. Who knows what it might be? Who knows what it's going to be called? It doesn't matter what it's called. All that matters is the yield curve is inverting. And so we can see this trend heading into 2020. We're already past the green, which is healthy, and we're falling into, if it goes below zero, that's an inverted yield curve. So remember this friendly old chart right here? Yep, you guessed it. We're right here at the peak of an expansion. We have the best economy in the history of the United States. Unemployment is low. There is a great amount of jobs. Taxes are low for corporations. Taxes are low for individuals and families. And also government spending is at, record levels. These three things are really pushing inflation high. And that means things are going through the roof, which is great. Except, remember that pendulum? What goes up must come down. And so we're going to go into a contraction here. I estimate within the next 12 to 36 months. I will leave you with this note here. We all remember the interest rate hikes from the Federal Reserve in 2007. Now we can see a similar trend that's starting to happen in the last 3 years. Interest rates are going up again because the Federal Reserve, they're not dumb. They know this. They know everything that I know. These people went to the same top MBA programs around the world that all the top economists did. And so you can see in 2000s, as inflation was going out of control before the housing crisis and during the housing crisis, the Federal Reserve was jacking up interest rates, which caused the interest rates on lending to go up, which caused adjustable rate mortgages, lending mortgage costs to go up. And then when the economy collapsed, they pulled that lever and they made the interest rate zero. So what we can see right now, to adjust for the inflation that's happening, to keep the inflation at 2%, Jerome Powell is, with his Federal Reserve right now, is raising the interest rates in anticipation of a global economic or a U.S. economic collapse, so he can pull that lever to drop interest rates to zero. And by raising interest rates now, that's forcing our economy to slow down. So, in conclusion, as we've discussed and learned, the interest rates are going up right now in this record-breaking bull run. The inversion curve for the Treasury yields is coming. It's already started with the 2 and the 5-year note. So you can thank me later. Get out of the market now. Get as much cash as you can. and be prepared for a recession. So when everything bottoms out, you can go in and take advantage of all those buying opportunities. So if you liked what you learned today, go ahead and hit the subscribe, and I look forward to other podcasts in the future. Thanks.